Lasse Heje Pedersen, Efficiently Inefficient, How Smart Money Invests and Market Prices Are Determined. Dive into the world of smart money investment and understand the intriguing dynamics between market efficiency and inefficiency in Lasse Heje Pedersen's Efficiently Inefficient. Unravel the strategies employed by successful investment managers, the importance of liquidity risk and information advantages, and learn how professionals like George Soros ride the waves of macroeconomic events. Discover the unique characteristics and operations of hedge funds, their role in maintaining market efficiency, and how they strategically design revenue-generating portfolios. This book summary will unravel the mystery behind making the right investment choices and help you understand the complexities of the financial market.
Mastering the efficiently inefficient market. Economists assume markets are efficient, but human emotions create pricing errors, providing room for profit. Competitive investors trying to beat the market push it toward efficiency, but rewards are available. Every stock's efficiency level changes continuously, making it a challenge for investment managers to exploit these dynamics. Successful managers use experience, knowledge, and resources to formulate profit-making strategies. Hedge funds tend to be the most unrestricted and sophisticated investors, with different game plans to gain profit. Some focus on global macroeconomic events, while others use their information and technological advantage to execute trades. Investment styles such as value investing and liquidity provision can also be used. In the end, only those who master all the required skills can reap the benefits in an efficiently inefficient market. Hedge funds, the secretive asset managers. Hedge funds are a type of asset management firm that employs short selling and leverage to achieve their investment goals. They operate with fewer regulations and charge fees on positive returns. The sector manages over $2 trillion in assets, and their use of leverage means that total positions are much larger than asset value. Despite their secretive nature, they have become an essential component in making the financial markets efficiently inefficient. Hedge funds cannot solicit clients, and as such, primarily sell to sophisticated investors such as institutions or high-net-worth individuals. The alpha and beta of investment. The capital asset pricing model, CAPM, theory separates investment returns into beta, alpha, and idiosyncratic risk. While beta adds little value, alpha is the key to active investment management. Hedge funds monitor their returns and test strategies to increase alpha. However, identifying alpha is challenging, as prices are often pushed away from their fundamental values. Investors also need to consider transaction costs while designing their investment strategies, as these can significantly affect their returns. Managing risks in hedge funds. The role of liquidity and margin requirements in hedge funds. Hedge funds are all about managing risks associated with portfolio construction, market positioning, and liquidity spirals. Compensation for liquidity risks and market positioning are imperative for picking the right strategy and security. Market liquidity risks result from high and unpredictable costs, while funding liquidity risks stem from leverage. Hedge funds estimate transaction costs of trades before execution to ensure a profitable outcome. Margin requirements limit the amount investors can borrow to buy securities, restricting funding risks. Hedge funds monitor and maintain margin cash requirements in case the lender calls in the leverage margin. In portfolio construction, estimating risk and determining the size of each position while achieving an optimal trade-off between risk and expected returns is crucial. A liquidity spiral is a negative feedback loop that occurs when leveraged securities prices drop and lenders increase margins, leading to more liquidation events. That leads to further price declines, more margin calls, and more liquidation until prices begin to settle. Such events can quickly spread to other market segments with significant consequences, as was the case in the 2007 subprime mortgage market crisis. In conclusion, risk management is not always a losing proposition. It saves investors a tremendous amount, and as the saying goes, your first loss is your least loss. Hedging against risks in hedge funds requires an in-depth understanding of market positioning, liquidity, and portfolio construction, and margin requirements. Strategies for profitable investing. Investing can be a daunting task, but with the right strategies, investors can generate consistent profits. To achieve this, an investor needs asymmetric knowledge and an advantage in information. There are three core strategies investors use: equity, macro, and arbitrage. Equity strategies involve picking the right stocks based on the company's fundamentals, quality of management, and sustainability of profit growth. Macro strategies use factors influencing world markets to determine where to invest. Meanwhile, arbitrage involves exploiting price discrepancies in inefficient markets. In summary, investors should consider information that other investors overlook, new ways to combine different sources, and smart ways to obtain information quickly to generate consistent profits. The 6 characteristics of profitable portfolios. Portfolios are collections of a firm's assets that can develop organically or be actively designed. Investors must be aware of their portfolio's risks as they can amplify each other. Profitable portfolios have 6 characteristics that include diversification, limits on asset positions, focusing on securities with the greatest potential, and low correlations among the securities' risk factors. Asset allocation portfolios require decisions on asset types, weights for each class, and weight adjustments to respond to market changes. Mixed strategy hedge funds formulate allocations across equity, macro, and arbitrage strategies and determine rules for changing strategies. Managing hedge fund risks. Hedge funds require robust risk management to balance expected returns and risks. Common risk measurements include standard deviation of returns for volatility in value at risk, VaR, among others. Stress tests simulate portfolio risks in extreme events. Highly leveraged hedge funds use drawdown controls to manage losses and ride out crises, based on maximum and current drawdowns, as well as VaR.
Efficiently Inefficient offers a comprehensive view of smart money investment and the role of hedge funds in achieving market efficiency. As you explore the strategies utilized by successful investment managers, you'll discover the importance of liquidity risk, information advantages, and leveraging macroeconomic events to your advantage. Through understanding hedge funds' unique characteristics, operations, and portfolio management, you can grasp the delicate balance between market efficiency and inefficiency. In the end, Efficiently Inefficient provides invaluable insights into the world of investment management and equips you with the knowledge required to navigate the financial market effectively.